Hello everyone, this is Project 4 for Accounting 309 at the University of Southern Mississippi for Dr. Wilson. This project is the Accounting Information Systems, the Revenue Cycle, and this project is presented by me, Ethan Daly, Cameron Cook, Gabriella Jones, Audrey Cronin, and Brianna Lewis. So what is our purpose? Our purpose is to understand the revenue cycle as well as the many cycles that make up the cycle as a whole. Then we want to look at the threats and controls of these cycles and see how they make up and compare to our companies. The companies that we chose were Walmart and Amazon. And the reason we chose them because they ranked in the top 10 grocery store chains in the US. We wanted to compare Walmart and Amazon because they are different storefront types. While Walmart is a traditional storefront where you can walk in or order online, Amazon is a online only order system. So we wanted to see how their revenue cycles compared to each other and how they differed. So I've mentioned the revenue cycle a couple times now, but what is it? Well, the revenue cycle is the set of business activities and related information processing systems that are associated with providing goods or services to customers in exchange for cash. The basic parts that make up the revenue cycle are the sales order entry, the shipping, billing, and cash collection. And we will go into these parts later in more detail. But why does the revenue cycle matter? Well, first, it's how the company gains capital. It's how they run their business, how they collect money. But it's also very important into data collection. They can collect the data from these information systems and analyze the business and see if they're on the right track. They can ask questions like, are the products customized to the customer enough, or can we do better? How much inventory should we hold? Or how is our product being delivered to customers? The purpose of the revenue cycle is to analyze it and see if the business is providing the right product with the right price, and how these companies can take this information and use it to their advantage. Before going into the detailed parts of the revenue cycle, I want to take a quick look at the general overview of everything of the revenue information cycle. So first we want to look at the process. That means everything from the order placement to the cash collection. So when the order is placed, the company will check if it's a credible customer. Then the order will be sent to the warehouse where they will check if they have the inventory in stock. Then they will ship it, bill it, and collect cash on it later. This general overview will be similar for every company. So when we compare the Walmart storefront and the Amazon online order system, this general process will be very similar with a few slight deviations in between. For threats and controls, threats are negative factors that can bring harm to the business, and controls are the procedures or rules that the company sets up to prevent these. Some basic threats that every company will face is inaccurate data, unauthorized data disclosure, loss of data, and poor performance. And the controls that a company can set up to prevent these can be things such as data checkers, uh, data restrictions on who can access it, backup data, and general performance checkers. So while the threats may harm the business, the controls are what keep those threats in check and prevent harm from coming into the business, and so we can continue operations.
The revenue cycle begins with the sales orders from the customer. Customers' orders were originally entered into the system by employees, but new technology has made it possible for the customers to do this themselves. There are three steps to the sales order entry portion of the revenue cycle. The first step is to take the customer's order, which allows the business to see what they are buying, the price, the terms of sale, and the quantities of the items. It is important for the information in a sales order entry to be complete and accurate so that there is not any miscommunication or errors. Errors can affect a customer's view or relationship with the company and potentially decrease sales. The second step is to check the customer's credit and give approval for the sale. This is important so that the company can reduce the number of uncollectible payments. Uncollectible payments are one of the threats to companies during this stage, and setting a credit limit is another way a business can combat this. A credit limit sets the maximum credit balance for a customer based on their credit history. The third step is to check the product's availability in the inventory. Inventory needs to be kept up with so that they know when back orders are required. Most companies will let a customer know if they are out of stock on an item or close to it. This information helps determine when the customer will receive their items as well. Products from Walmart can be bought both in-store and online. When buying items in the store, items are still tracked and accounted for by Walmart. The items are scanned by the cashier, which gives information on the selling price and other inventory-related information. The in-store process is still prevalent because it allows for face-to-face interaction with Walmart employees. In-store purchases still require management to check inventory as sales associates help customers find items. In some instances, there are items that can be purchased online but not in the store, and vice versa. The self-checkout line is another way that customers can purchase products in store, but it eliminates the face-to-face interaction. A sales order is still created at the checkout, only that now customers scan the items themselves. All of the scanned items and information relating to them are then inputted into Walmart's inventory database. The sales order entries for Walmart online are placed when the customer adds items to their cart and check out via the Walmart website. Buying online has proved to be very efficient and gives less room for human error considering that orders are placed electronically. The availability of items are also shown on the website before the customer checks out so that there is not any confusion, and allows customers to place a back order themselves depending on the item. Sales order entries made by Amazon are very similar to the online process for Walmart. Orders are placed by the customer and related information about the items are put onto the sales order entry. One thing that stands out between Amazon and Walmart is that Amazon helps broker sales transactions from third-party sellers. This requires Amazon to be in contact with third-party sellers as well as make sure that the sellers have an adequate amount of inventory in order to sell through their online platform. Since orders made on Amazon are paid before they receive the items, uncollectible payments are less of an issue. An example is that if a customer's card declines, they are notified and the order is not placed until the customer has a sufficient payment method. Amazon is also known for mostly being online with the exception of their Amazon Go stores. Amazon has a good track history of keeping up with inventory considering it is their main focus and that they have a large amount of warehouses around the US. As does Walmart, Amazon gives tracking numbers to customers to help update them on the arrival of their items. They also have online customer service and provide a telephone number if any help with purchases, cancellations, or tracking orders are needed.
The second step in the revenue cycle is the shipping process. The shipping process begins once a customer's order has been received and accepted. The shipping process has two steps: picking and packing and shipping the order. During the picking and packing step, a pick slip, also called a picking ticket, is generated. The pick slip is used to identify which items the customer has ordered, as well as the quantity. Once the order items have been gathered, they are processed to the shipping department. This leads to the second step of the shipping process, shipping the order. This step involves getting the packages ready for delivery. Both a packing slip and a bill of lading are generated and shipped with the order. The packing slip contains the quantity and description of each item included in the shipment, and the bill of lading identifies the responsibility of the goods. The order is then shipped via the chosen delivery method. Now let's look at Walmart's shipping process. Walmart provides both in-store and online shopping. When shopping online, customers have the option to pick up orders from their local store or to ship the item to their house when available. Since Walmart does not ship items from stores, all orders that are shipped directly to customers come from distribution centers. It is at these distribution centers where Walmart's picking and packing step and its shipping the order step take place. The delivery methods that Walmart uses are USPS and FedEx. USPS are used for smaller items, while FedEx are used for larger items. Next, we will look at Amazon's shipping process. For Amazon, the picking and packing steps take place in sortable fulfillment centers and non-sortable fulfillment centers. The sortable fulfillment centers are warehouses where the smaller items that the company sells are stored, such as books, toys, and houseware items. The non-sortable centers house the larger items that the company sells, such as rugs, furniture, and large equipment. Once these items have been picked and packed at these warehouses, they're then trucked to sortation centers. At these sortation centers, packages are sorted by zip code and then consolidated onto trucks for faster delivery. After this step, the orders are ready to be delivered. The delivery methods that Amazon uses are Amazon Logistics, UPS, USPS, and FedEx.
So now that we have discussed the two prior steps of the revenue cycle, which were sales order entry and shipping, I'm now going to be discussing the billing section. So the billings mini cycle has two steps, which are invoicing and accounts receivable. Invoicing includes the sales order and the shipping information into one singular invoice. That way everything is easy to find and track. The second step is the accounts receivable, and the information on the sales invoice shows up here, and it is a debit to the customer accounts before they have paid, and then after they have paid, it then becomes a credit. Walmart and Amazon both have an automated process, so after the payment is received, whether in store or online, the invoice comes either in an email on a piece of paper, but it's like a virtual document, and in the store it will come out as a receipt. So the reason that they do this after the payment is processed is to prevent people from not getting billed or losing track of this information. Now that I've discussed what exactly the billings is, we are now going to specifically talk about Walmart's version of billing and Amazon and compare the two. So Walmart has 3 or 4 different types of way that products are bought through their site and their in-store. So whenever things are bought in the store, like your typical Walmart, you will go through the store, get your items, and then you'll go to the checkout aisle, scan your items, and pay, whether in the form of a card, cash, or a check. So all 3 of these things have to be processed before the items are purchased, therefore creating a control because there will be no liability if the payment is received just as the items are received for the customer. However, with cash, there is the liability of the people who are managing the cash who might mismanage or do certain things with that cash, but in general, the money is received when the customer gets the items. However, when shopping online, the items are added to the cart, and once the customer wants to check out, it goes and clicks checkout, and then the payment is entered, whether it's a card or PayPal, and that payment has to be approved before the order will go through, which then again creates another control in the same way that the in-store did. And pickup and delivery works the same way, so delivery is kind of similar to in-store, and the pickup option is where you just drive up to the store and you get your items, but you have to prepay before you pick up your items. With pickup, it also poses the risk of customers having a substitution for their product. So let's say I want Crest toothpaste and that's what I bought, but the person in the Walmart store who is picking out my items, the only option is an off-brand toothpaste. So what will happen there is I will get credited for the refund for the difference between the Crest toothpaste and the off-brand toothpaste. And after all 3 of the options are done, a bill will be sent in one form or another, whether it's a physical receipt or in an email. So Amazon is very similar to Walmart in their process of billing, except Amazon only has 2 options, which are online and they're in-store. So for online, the items are placed into the customer's cart, then the customer checks out after placing their card information, PayPal, or whatever form of payment they're using. So Amazon receives the money at that time. However, sometimes Amazon does use third-party vendors, so that creates a difference there because the money will go to the third-party vendor instead of Amazon directly, and Amazon will also receive their portion of that. So after the order is processed, a bill is sent in the form of an invoice, which includes shipping information, the cost of the item, sales tax, and so forth. The second option for Amazon is their in-store option, which is called Amazon Go. So this store uses a lot of technology, and this technology is very similar to that of a self-driving car. So the customer will walk in, grab their items, and leave the store. And the way that this is possible is because Amazon has technology to where it can tell who is taking items off of the shelf and when items are put back by the same customer. So let's say I grab a water bottle off the shelf, decide I don't want it, put it back. Amazon will know that, and I will not get charged for that item. So Amazon knows exactly what I take off the shelf, what I put back, and it calculates that total amount as I walk out of the store, and that total is sent to me by an invoice through email once again. And if the payment is not received at the time, the customer cannot leave the store. So it's a very quick process. However, the controls are still in place in this online store throughout the technology that they have.
The final step in the revenue cycle is cash collection. This is the step in which customer payments are collected and processed. There are a few ways in which cash can be processed. There is remote deposit capture, where payment checks are scanned and files are sent to the bank digitally. Another method is a lockbox, which is a physical address that customers can send their payments to. The bank will pick up the checks and then send copies to the company. This can also be done electronically, where the bank simply sends a customer's account information. These methods can be efficient and time-saving, and on some occasions reduce costs. However, customer payments can be sent directly to the bank via electronic funds transfer, which is quicker for both the customer and the company. The difficulty with electronic funds transfer is the amount of data that companies require to properly account for payments. This issue is relieved by financial electronic data interchange, which allows the customer and the seller to simultaneously send and receive all necessary data at once. Additionally, when using EFT or FEDI, companies should have a universal payment identification code, which allows customers to pay with ACH credit without being able to access a company's account information. EPIC is a control used to protect the company. Other controls include separating physical payments from accounts receivable, or anyone who can post to customer accounts, authorize credit memos, or reconcile bank statements. This can be done by having a remittance list of all payments or sending copies of payments to accounts receivable. If these steps are not taken, it can lead to embezzlement or other forms of theft. Another precaution to use would be a cash flow budget, which can estimate or predict inflows and outflows of cash and give the company time to act accordingly. For Walmart, customers can pay in-store with cash, card, or check. All of the same methods can be used on their website or app with the addition of PayPal. Now, Walmart allows online pickup orders to be paid for in cash at the time of pickup. Arguably the most popular payment methods in physical or online stores is a credit card, which allows for a quick transfer of payment via a third party. Most often, a quick and widely acceptable payment is EFT. When paying with a card, the money goes directly from the customer's bank account to the company's, like Walmart. Walmart is also known for its money centers, where customers can cash or print checks, get money orders, or prepaid debit cards or credit cards that can be used in their stores. Amazon is a primarily online retailer and grocery that allows customers to have almost anything delivered to them. Because of this, all of their funds are transferred electronically. When Amazon began opening physical locations, they decided to continue using their system of exclusively electronic payments by requiring customers to scan a code on their phone or their card. To prevent theft, their shopping carts have weight sensors and scanners that register every item that goes in and out of the cart. Since they do not accept cash payments, there is no use for any cash registers on site, which also lowers the chance of robbery. This method allows Amazon to track all of their customer transactions in the same way and promotes consistency and efficiency. This concludes our presentation of the revenue cycle.